Let's dive into a genuine mystery, one that sits right at the heart of our economy. We're going to look at a groundbreaking paper by Robert Shiller that basically put the entire stock market on trial. And what he found? Well, it changed everything.
We've all seen this, right? The market skyrockets to these insane highs and then just crashes spectacularly. It feels, I don't know, a little too much, a little excessive, but is there a rational, logical reason for all that chaos? That's the mystery we're going to dig into today.
For a long time, the official story, the textbook answer, was this thing called the efficient markets model. And the idea behind it is pretty straightforward. It says a stock's price is just the value of all the dividends it's expected to pay out in the future. So when a price moves, it's just reacting to new information about those future profits. It's all supposed to be perfectly rational.
But then, in 1981, this economist, Robert Shiller, came along and decided to actually put that theory to the test. He came up with this brilliant way to see if the market was really as smart and rational as everyone thought it was.
Shiller's idea was just genius in its simplicity. He basically asked, what if we had a crystal ball? What if we knew, for a fact, every single dividend a company was actually going to pay out, from now until forever? What would that stock price look like?
He called this the perfect hindsight price, or P-star for short. It's a price you calculate by looking backward at a century's worth of dividends that were actually paid. This P-star, then, is the perfect, totally rational price the market should have had if it was only trading on facts. It's our rational yardstick.
So, Shiller has his perfectly rational price. The next logical step? Compare it to what the actual stock market was doing. And oh man, what he found was absolutely stunning.
So first, here's the real-world S&P stock price from 1871 all the way to 1979. And yeah, it's just all over the place. You see these wild swings, crazy peaks, deep valleys. This is the volatility we all kind of know and expect.
Okay, now here is Shiller's rational price, his P-star, for that exact same time period. Just look at that. It's so incredibly smooth. And that makes sense, right? It's based on actual dividends, and companies don't really change their dividend payments that drastically from year to year. So the rational price is just remarkably stable.
And now, the moment of truth. Here they are, together on the same chart. That jagged line, that's the real market. The smooth line is what the rational theory says should have happened. I mean, the mismatch is just enormous. The actual market's moves seem to have almost nothing to do with the fundamental value it's supposed to be tracking.
Shiller himself had the perfect analogy for this. He said, imagine the smooth line was the actual temperature outside, and that crazy jagged line was your local weather forecaster's predictions. You'd think that forecaster was completely unhinged. You'd fire them on the spot. And this wasn't just a small error. Shiller actually calculated it. The stock market was 5 to 13 times more volatile than changes in dividends could ever justify. The theory wasn't just a little bit off, it was dramatically, fundamentally wrong.
But hold on, a good investigator has to rule out other suspects, right? Maybe there's something else going on. Maybe the model isn't broken. Maybe Shiller was just looking at the wrong clues. So, the first big objection you always hear is, well, what about earnings? Shouldn't we be looking at company profits, not just the dividends they pay out? I mean, reinvested profits create value too, don't they?
Well, not quite. Financial theorists will tell you that's kind of like double counting. See, $1 of earnings can either be paid out to you today as a dividend, or it can be reinvested to create future dividends. You can't count both the seed and the apple that grows from it. At the end of the day, the dividend is the actual cash that lands in an investor's pocket, so that's the right thing to measure.
Okay, so suspect number 2. We know the value of future dividends depends on the interest rate you use to figure out their worth today. So maybe the market wasn't reacting to news about dividends, but to wild swings in real interest rates?
Shiller ran the numbers on this too, and what he found was just absurd. To justify how volatile the market was, real interest rates would have had to swing from -8% all the way up to over 17%. I mean, those are gigantic, implausible swings that just didn't happen in the real world. So that suspect is cleared too.
So, with the main counter-arguments out of the way, the evidence all points to a really clear conclusion about our original mystery.
The verdict is in. That simple, elegant, efficient markets model, the one that says prices just rationally reflect new information, it just can't explain the historical behavior of the stock market. The volatility is just way too high.
And this is the profound takeaway from all of this. If it's not pure logic driving the market, then something else has to be. Shiller's work basically blew the door wide open for behavioral economics, the study of how human psychology, our emotions, and even social fads can influence financial markets.
And this leaves us with the ultimate question, doesn't it? If markets aren't these perfect, rational calculating machines, then what are they? Shiller's work suggests they might be more like mirrors, reflecting our own collective hopes, our fears, and our manias. And that is a mystery that affects us all.